Hello, this is Dustin with Dustin's Dollars. Today I'm going to be talking about Tellurian and about the 2027 11.25% notes that were just announced today. I'm going to be talking about the impact this has on the cash flow model that I most recently published. Before I begin, let me remind you that I am not a financial advisor or a financial professional of any sort. All opinions that I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in Tellurian, so this video should be for your entertainment purposes only because I could be wrong about everything I say in this video. You need to do your own research before making any investment decisions. So, Tellurian, as we saw today, if you're interested and invested in the stock, stock went way down. Why did it go down? Because people saw the headline. They saw Tellurian is issuing some debt and issuing further dilution in the form of warrants. And so let's talk about this today. I'm going to go through this real quick in terms of just the structure of the notes and the warrants. And then I'm going to go through sort of the impact as I see on the cash flow, the discounted cash flow valuation that I have for Driftwood LNG Phase 1, and sort of render my own opinion on what I think about this as far as whether I thought that this was, if you really want to put it in black and white terms, if it was good or bad. So the notes, right? The highlights, they bear interest at 11.25%. They are due in 2027, and for every $1,000 principal that you purchase in the of these notes, you will also get 75 warrants. After some period of time, the notes and the warrants I think are going to separate, and they'll be separately tradable. That's somewhere down here in the in all the fine print. Hello, transient stacker. Thanks for joining the stream. Let me know if you have any questions or comments today. And again, they are getting, whoever buys these notes is going to get 75 warrants, right? So it equal to 75 shares of stock per $1,000 of notes that they purchase. And the strike price on those warrants is 120%. Where is it at? Somewhere down in here. It says 120% of the trailing 30-day volume-weighted average price of our common stock. And I did not read I didn't see it in the fine print. And of course, I haven't read this whole thing word for word. It's pretty long. I did skim it. I'm unsure if this is specifically a 30-day calendar window or a 30 trading days. I'm not sure that it matters that much because I think we can get a rough idea of what that number is either way. Now, the biggest thing about these, maybe not the biggest thing, but one of the biggest things about this particular offering is, this is a preliminary offering, and they did not even state yet how much they are raising through this. There was a post in the Discord today where somebody had some sort of a source, I think from Bloomberg, that indicated they were looking for up to $1 billion. But that is not actually in the SEC filing. So, I take that with a bit of a grain of salt. So we really don't know, although I'm going to be using that $1 billion number here in some of my calculations, just for, illustrative purposes. So that's what I'm going with today. Now, and then the other major question that you should have when you see bonds or notes like this is, what is the collateral? And we can scroll down through here and we should be able to see the word collateral is going to be all over this thing. Let me see if I can get a more, because I have it in my notes here. By the pledger in Driftwood. Here we go. So the actual collateral has a first priority lien on all of the equity interest held by the pledger. The pledger here is Driftwood. I don't recall. I don't recall the specific legal entity, but the point is, these are notes using the equity interest in Driftwood as the collateral. And I think, but I'm not sure, again, I am not a financial professional, but I am taking this to mean that this is not directly against the actual assets of the Driftwood terminal itself. And that's somewhat backed up for me, I think. But if you look at some of the covenants on the loan, you can see, let me scroll up to the actual statement that I'm reading here, is they basically say, you can't you can't take on additional debt for a whole bunch of things. However, you can if it is one of these following reasons. And they have a whole bunch, like applicable law, blah blah blah, all these sorts of things that are stuff that doesn't really make a whole lot of difference to me. And then the very last one here that presumably they tacked on top of all this boilerplate is any driftwood financing, right? So it's very clear that Tellurian can still pursue driftwood financing, and that this, there's no particular restriction on them doing that. So again, this is sort of, for me, I am interpreting that to mean that these particular notes do not have a first lien on the driftwood assets themselves. It's on the equity interest in the production of that terminal there. So I thought that was so that's good. And so there was a discussion in the Discord today, and it sort of was along the same lines, confirmed what I had sort of thought when I got to skim through this earlier this morning. And all of this to take away that this is more forming the equity portion of the Driftwood project financing rather than the actual project financing itself, the debt portion. So that is how I have modeled this out today. And a couple things. First of all, what is the real quick? What is the 30-day volume weighted average price? The price that we would be looking at for those warrants, right? The strike price there. I guess you call it strike price for warrants. I got the last 30 calendar days worth of trading data from Yahoo Finance. This is not going to be precise because it's not actually the volume weighted price on each of these days. But what I did was I took the high point and the low point and just computed the average of those for every day, and then weighted that day by the volume. So this should be a pretty good approximation, even if it's not perfect. And maybe that's too small for you to see. I could probably make these numbers larger. But what is interesting is this came out to, at least with the data I had, almost exactly $4 for the trailing 30 days volume weighted average price, which would mean that the sort of the strike price on those warrants at 120% of that would be $4.80. So that is what I've used in my calculations. Now, another thing just to think about is, when we start to look at what are the particular cash flows for, how does this impact the cash flows? And even in the short term, what impact do these notes have? And so I put together just a super, super small little spreadsheet for myself to think about this. And it was, I kind of like what they did here. And let me explain for just a second, right? So Tellurian is going to get cash up front, cash that they desperately need in order to, they don't desperately need in order for the company to exist, but they do desperately need cash in order, sooner or later, to go towards Driftwood, right? They need a whole pile of money that they can send over to Bechtel and say, here, commence with the operations. And so with these particular notes, Tellurian is getting that up front. Then for the next 5 years, right, Tellurian is going to have to be paying interest on those notes. And my theory or my understanding is that they're probably going to do their best to pay that interest with their gas production that they have ongoing right now and all their earnings from that arm of the business. And then this is my year by year sort of what does this look like for the cash flows to Tellurian from the notes. So they're going to get a bunch of cash this year, pay interest over the next couple of years. Hopefully they can cover that from their gas production and sales. And then in 2027, they're going to have to pay this back. However, in 2027, that is also the term on the warrants, right? The warrants are 5 years. I don't know where it's stated here. Let me see if I can find it to prove it to you, so you don't have to take my word for it. Warrant. Oh, come on. Go back to the top. Oh, it doesn't say easily up here, does it? Anyway, somewhere in here, it says it there for 5 years. I'm sure I could find it here. Description of the warrants. This is probably say 5 years listing. Oh, I failed. I can't find it. But I'm nearly positive that these are 5 years. Oh, here we go. The warrants. I mean, I guess they're going to expire on blah 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 whatever 2027. And I think they're going to be the fact that the notes and the warrants are going to have roughly the same time frame is kind of nice, because it means that either Tellurian is going to get that money from those warrants being exercised, and that money would actually be, I think it's $360 million. What is this? I think I had it already with my calculator. 4.8 times 75. Yeah, $360 million. They're going to be getting that cash at the same time that they have to actually be paying back these folks for their notes here in 2027. And in 2027, presumably, that is long enough for Driftwood phase one to actually be in operations for them to be generating some cash. And so hopefully this is not too big of a burden on the company. And if it is, if it happens to be sort of a short-term thing, I'm sure they could probably do some additional financing at that point in time, right? Once they have the facility there and up and running, I don't think it'll be hard for them to get even a short-term loan, or some sort of refinancing for these particular notes. I saw something on the chat. Let me see. A transient stacker says, someone suggested that this means Tellurian is putting off financing for a while longer. Maybe, we don't know. Like I remain, let's say I remain optimistic, but also skeptical at the same time. I've been in this company, invested in this company for multiple years, and things have never gone as I think they are going to. But at the same time, there's enough unknown with this one, right? And I think for me, I would make that determination, sort of looking at their intent based on how much they do end up raising with it. Sorry, I should look at the camera. How much they end up raising with these notes. I think if they are actually raising $1 billion, it's hard for me to think they're going to do much with $1 billion other than use that as a portion of the financing for Driftwood. And I think this is I still haven't finished sort of making my own determination on going through their current progress and how far I think they can go before they need, a ton of money. But I think sometime in the next, roughly, I'm guessing like 6 months, 9 months, they're going to need a ton of money in order to, let's just work backwards, right? They're going to need a ton of money so that they can issue the full notice to proceed to Bechtel, right? And that's, if you open up their contract that they have with Bechtel, it basically says, well, we need you to basically convince us, show us somehow that you're going to have the money to pay for all of Driftwood LNG phase one, and before you can actually issue the full notice to proceed to us, and we'll accept it, or whatever the actual legal terms are there. So if you work backwards from that, right, Tellurian's going to have to borrow a whole bunch of money from somebody for the actual debt portion of the project, and that's not going to happen unless they have a good chunk of their own collateral to put up. And so again, I think if they're getting $1 billion here, that's a large portion that can be used as collateral. You add that to the cash they already have on hand, that's a good chunk of what they might need from this. If they do this offering and they once again are only raising, let's say, $500 million or even something smaller than that, that is starting to, that does make me worried, and would, I think, play into that that suggestion that you said someone made of, Tellurian is putting off the financing longer, right? But I think it's, again, for me, it kind of comes down to the magnitude of how much they end up raising, and we don't know that yet. It was not. This is just a, quote unquote preliminary prospectus, and they did not fill in those details, and we don't really know. So we'll find out. Presumably, we'll probably know that in the next. I don't know for sure. I would guess the next couple of weeks, right? The last time they did something like this and they did the convertible notes, I think it only took them roughly 2 weeks from when they publicly disclosed this, and filed the preliminary filings and then actually closed it. So we'll see. Thank you for the comment. So where was I in this? Yeah, all I was saying here, and this just to wrap it up and then to move on to the actual cash flow model, is it is pretty interesting that Tellurian is going to be getting all that cash from those warrants right at the same time that they have to actually pay back these investors, right? And so you would expect that the stock price is going to be above $4.80, so everyone is going to want to exercise those warrants and actually get the shares. And so, yes, there will be that dilution in the future, but it will be at the same time that Tellurian has to pay this back, and they'll be able to use that cash, sort of take it straight from the warrants and hand it right back to these investors. So I thought that was, a bit interesting here and a bit nice. And I think, I again, this is just using the illustration of raising $1 billion. And the reason why I don't think I stated this, the reason why I'm using a 975 here, meaning $975 million, is because I'm assuming there's going to be some fees. I just arbitrarily put, what would it be? 2.5%, I think there. Did I do my math? Yeah, I think 2.5% there as a fee. I we'll see what they actually are. They didn't disclose this yet, and so we may not know until they close these notes. So, anyways, I went ahead and sort of updated. I didn't update my publicly shared model yet. I'm going to figure out what the best way is to model this in and let other folks put things in there. But at least for now, sort of a quick and dirty way for me to model this, I did update my cash flow model that I shared last week. I think is fairly recent, just to look at what the impact of this would be if they actually raised $1 billion under those. So let me walk through this briefly. And so let me put these columns here. Let's say this would be original model, and this would be with 2027 notes. So nothing really changes with the actual, what I need for the project. I'm not making any changes to those assumptions. And let me just delete that for now. So go down here. The first thing to change, I put these in bold, was how much cash they actually have available for equity. And now this is kind of a funny thing, and maybe I did a bad job or a bit of a weird way to model this. This is why I'm considering what the best way is for me to model this. However, in terms of their current cash that they have, I don't know why I did that. I should have put this in here. Anyways, this is how I was doing this a little quickly. They actually, I am saying that they have less current cash available to be used for equity in Driftwood because I am subtracting off the interest they're going to have to pay from 2023 to 2026. And so, again, you might disagree with my modeling of that, but this is how I'm looking at things, because I sort of pulled forward what I think their earnings are going to be for the next couple of years, and so have to subtract off these interest payments in terms of that, because those are earnings, but now if they're paying interest, those earnings are not available to be used towards Driftwood as equity. But then simultaneously, I also subtracted off some of the equity that they would need to raise, because although they have less current cash, then they have to raise less for the equity because they are getting that almost $1 billion worth. Again, I used 975 million because I assume there's going to be some fees on this raise, but then they need to actually raise less equity. And so as of right now, they would issue, based on my model here, my original model was they'd have to issue about 800 million shares for the equity, or whatever the equivalent is in terms of whatever other instrument. Under this, they would actually only be issuing 700 million shares. And again, I recognize that there's, this is more shares than they currently have authorized, but this is kind of how I'm modeling it out. So less shares, less dilution. Then going down, none of this changes, right? Their natural gas production doesn't change, LNG revenues, none of that changes, and their what am I looking at here? The initial, just rough cash flow for Driftwood operations doesn't change. However, now once we go down here, we're starting looking at valuing the company, right? So what does change is their outstanding debt, and this would be roughly in a $1 billion of outstanding debt. But then what I also did was I subtracted off the 360 million for the warrants, because they're going to get that cash at the same time they'd be paying off this debt from the 2027 notes. So I sort of just subtracted off, and sort of net, it is an addition of $640 million of debt, and their shares outstanding would be, the dilution that I showed up top, plus another 75 million shares, assuming that the warrants do get converted into shares. And so overall, the change in the sort of value per share, they'd be getting more cash flow per share, but they'd also have more debt effectively, right? Because they didn't just straight up issue equity. And so the value of the equity per share would end up being slightly lower, given this model at $10.17. And the overall share price, and when I say slightly lower, this is very, very small, right? It's a slight difference. And then I look at the overall valuation, and it changes just slightly. The full valuation would be, $20.63 billion, and then that boils down to my sort of predicted share price, if you want to call it that, or sort of the output of this model in terms of what the share price would be, discounted cash flows of $14.14, which is not that far off, like almost exactly what it already was, right? So in this model, there's slightly more debt, slightly less dilution than what I was originally picturing in terms of what they have to do for their equity piece. And my takeaway from this is, that they actually did this was a good move, right? And my basis for that, you might look at this and say, well, it looks like it's slightly worse than what your prior model is predicting, but in what I actually think here is my model was predicting a value that is drastically higher than the current price of the company, current price of the equity. And when they did this move, when I actually penciled this in, this is reducing uncertainty, right? This is me having less assumptions in the model, and it's still coming out to a value that is roughly the same, right? So we sort of reduced the set of assumptions, reduced the risk, and now it's roughly confirming, that I, given some of the other assumptions here, that we're still in the sort of $14 per share range, I think, for fair value at a positive full notice to proceed. So for me, I'm interpreting this as a good move. I think if they raise more than $1 billion, let's say hypothetically they raised a whole bunch of money here, I think that would get us even closer to this $14 per share rough valuation. And so overall, I think this was a good move. So granted, they haven't actually closed it yet, and so I can't really call it a good move at the moment. We'll have to see what the details are, and I'm sure some of these things could be tweaked, but yeah, that's my general opinion, and that's how I see it impacting things here, quantitatively. And so that's my basis for saying that, look, this, if I put this in here, again, I'm there's still some assumptions and what I just did there, right, that they're actually going to raise $1 billion from this, and what the fees are going to be, and exactly sort of how this is structured out. But they did give us more information. So the fact that there are, I think, less assumption in this model, and it's still coming out with a valuation that's roughly what I already had with my prior valuation, I view that as a positive. So sorry if I beat that dead horse a little too long. I need to use maybe a crude phrase. So yeah, I don't know if Transient Stacker or anybody else is still in the stream has any questions or comments. That was all my material that I had to go through today, and that's my general opinion on this. I think it was overall a good move. Not a huge not like a huge surprise to the upside, but I think for the stock to have dropped 14% today, I think that's a little bit ridiculous. I don't know if folks were expecting to not have any dilution or what. I'm not sure, but for me, some sort of dilution was certainly expected, right? As you saw here, I'm expecting us to have. I figured, just as a base case, that they were going to issue, 800 million more shares roughly in order to fund that equity portion of the project. All right, Transient Stacker says, how would you think the financing would be divided up with Tellurian putting in $1 billion? So I still don't think that they have quite enough money. It's hard to say in terms of if they get some banks who are interested in putting in a high proportion of the Driftwood project, higher than I'm expecting, right? I'm using 60% is going to be debt. If they got somebody who is willing to go even higher, then it sort of changes this. But I think as of right now, they don't have enough money, so they're going to have to do some more. They're going to have to issue some more equity or some more dilution, I think. And sorry, let me answer your actual question. Let me reread it. How would you think the financing would be divided up with Tellurian putting in $1 billion? So again, I think the biggest variable there, as I'm sort of started rambling on, is what percent comes from just straight up debt, project debt, and what percent comes from sort of other means that they have to raise money to put up as their own collateral that is not backed by the Driftwood assets themselves. And so that is the absolute biggest unknown. They've given us some numbers in the past of 60%, maybe of 2/3. I think they verbally said that in the past. I don't know if that was just a shortcut for 60%. But that's the biggest bit here. And so I think if you do go with the 60% number, and that's what I think what they've used in the past in their investor presentations, they have to put up roughly $4 billion here, I think. And that's a lot of money. They don't have it right now. And so, again, going back to what they have right now, they have about, I think off the top of my head, they have $650 million in cash kind of right now. And then they, in the future, are going to have some positive earnings, right, from their gas production and sales. And so, again, I had ballparked this at about $1.3 billion that they would have available, which means they need to close that gap and raise, I guess right now by at 60%, they actually need $5 billion in equity, right? So then they would need to issue all of this. I think even after they put up get another $1 billion from this, subtract off some of the interest, that effectively net gives them a little over $500 million more that they can put straight towards Driftwood, sort of adjusted, accounting for their future earnings. And then I straight up think they're going to have to just issue more shares, right? They're going to have some deal with somebody to say, look, we're going to sell you some equity. Probably will not be common shares, right? Because the folks who are going to be in this position to hand over a whole bunch of money to them are going to want, again, the speculation in the past has been like, BlackRock, I think BlackRock, I think I did a video about this a while ago, months ago, but about what BlackRock did with Cheniere early on when they were starting out. But if you look at something like that, right, that was sort of a preferred equity deal, I think, that would be convertible eventually into common shares. But I don't really want to speculate on too much on those bits, because ultimately whatever they issue is going to be convertible into common shares, right? And so I think, how is the financing going to be divided up, right? I think it's, again, we don't know what the banks are going to be willing to loan. I mean, I think Tellurian is going to take as much as they can get in terms of debt, right? If the banks will only give them 60%, they're going to take 60%. If the banks will go up to 70%, they'll take 70%. But I think Tellurian itself is, that's the straightforward part, right? They're going to get debt. They're going to have just, their bonds or notes or whatever. But the remaining portion, the shortfall between the cash that they have now and even the cash they're going to raise from these 2027 notes announced today, the remaining portion, I think, is they're going to issue shares or something that's convertible into shares ultimately, and that's how they're going to get that money. I don't know if I answered your question. I'm sorry. That was a lot, and hopefully that answered it. Let me know. Hang around for a minute if you're still there. Sorry, just as a side note, this application that I use, it does show you actually as a participant on the stream. It pops off and on. It's really awful. But I don't know how to fix it. Sorry, the thing that's awful is I can't always tell who's on the stream. A lot of times it'll tell me it's just me. So I will hang around just for another minute. If you have any other questions or comments. For anyone else who is watching this after the fact, let me just say, I do these streams live in the evenings on Sunday through Thursday, as many evenings as I can fit in, usually 9, 10, 11 p.m., somewhere in that vicinity in Eastern U.S. time zone. So, if you're ever interested, feel free to stick around, hop on the stream, and, chat with me through the live chat on YouTube. All right. I am not seeing anything else, and I don't want to, take up too much of y'all's time. So I am going to hop off now. Thank you, Transient Stacker, for joining the stream. I appreciate the questions and comments. Thank you, anyone else who is watching, and guess I'll hop off.